Thank you for joining us. Welcome to Business Incorporated. I am BC Adebayo. On today's program, Namibia seeks IMF funding to help fight COVID-19. South Africa's consumer inflation edges up to 2.2% year-on-year in June. Plus, Kenya's underlying economic numbers point to strong growth. Well, let's begin the show right away with numbers from the major markets here in Africa. And only South Africa's GSE was trading at intraday, and that index shaved off 1.26%. The markets in Nigeria and Egypt are closed for the Eid holidays. The NSE ended Wednesday's session positive 0.18%, while Egypt's EGX30 closed up by 0.29%. Kenya ended Wednesday's session negative. And most bourses in the Gulf ended low on Wednesday and are closed today for the Eid holidays, with Dubai's main share index down the most by 0.7%. In Abu Dhabi, the index lost 0.45%, and that was driven down by a 1.5% drop in Emirates Telecommunications Group and a 0.4% decline in First Abu Dhabi Bank. Qatar's index traded marginally lower by 0.04% as the stocks moved on the index sideways. The Saudi Arabia's stock exchange was closed on Wednesday but ended Tuesday's session positive by 0.05%. In Asia, stocks were mixed today after the U.S. Federal Reserve left interest rates unchanged. Mainland Chinese stocks dipped, with the Shanghai Composite down 0.23% to about 3,286.82, while the Shenzhen Component shed 0.66%. Hong Kong's Hang Seng Index slipped 0.69%, while South Korea's Kospi advanced 0.17% to 2,267.01. In Japan, the Nikkei 225 shed 0.26%, finishing at 22,339.23, while the Topix Index dipped 0.62% to end its trading day at 1,539.47. Over in Australia, the S&P ASX 200 gained 0.74% to finish its trading day at 6,051.1. Let's turn now to Europe, where markets pulled back this morning after U.S. Federal Reserve held interest rates steady. And of course, investors are also reacting to latest GDP numbers coming from Germany and the U.S. Well, let's talk to Chelsea Delany at the Frankfurt Stock Exchange for more. Good afternoon, Chelsea. Germany's economy contracted by 10% in the second quarter. That is the steepest decline since the 1970s amid coronavirus restrictions. Tell us how investors are reacting to this report.
Well, this number is certainly a shock for investors and for economists. It is a historic contraction for the German economy. It's the steepest contraction since they began collecting this data in the 1970s. It's about twice as steep of a decline than the previous records during the financial crisis. So clearly the German economy was hit very, very hard in these months between April and June by these closures. So that's spooked the market a little bit. If you see me behind me, the DAX is down more than 2%. But this is likely to be the low point for the German economy over the past few months. We have seen businesses reopening. We've seen production restart, and in the auto industry, for example, people are spending again. So we likely won't see a decline like this in the quarters ahead. We're actually likely to see growth in the quarters ahead. But still, this is a pretty steep hole for the German economy to climb out of. It erases the past 10 years of economic growth for Germany. So even as things do begin to reopen, there's still going to be a long time until the economy is back to the way it was before.
Well, the United States also reported a huge drop in GDP for the second quarter. What did the report show about how coronavirus is hitting the world's largest economy?
So this report just came out a few minutes ago, and so the U.S. economy actually contracted by 33% in the second quarter. That's a little bit better than people had been expecting, but it's really important to note when we talk about this number that it's calculated different than many other countries calculate theirs. So they're using an annualized rate where they take basically the decline in this quarter and say this is what it would be if we had this for 4 quarters. So it's looking much worse than, for example, the 10% contraction in Germany, but these numbers just aren't comparable. But that's still, that being said, the U.S. economy is suffering tremendously right now. There are still about 14 million people who are out of work in the United States. Soon, the jobless benefits that many have been living on will expire. And obviously, the U.S. has had a really tough time containing the virus. We continue to see lockdowns reemerging, new restrictions, new virus outbreaks. So even now, it's likely that the U.S. economy is really going to have an uneven recovery.
In other news, Chelsea, Volkswagen lost 2.4 billion euros in the second quarter and slashed its dividend in a move to conserve cash. Will things improve for the car maker anytime soon?
So this was a pretty shocking report for the markets, and that's actually one of the biggest reasons why the DAX is down so much today. Investors really weren't expecting Volkswagen to say that it was going to cut its dividend in this way. That's obviously very important for shareholders. So that's really spooked a lot of investors. The actual loss that Volkswagen reported, it wasn't a complete surprise to the markets. Investors had generally expected them to lose quite a bit of money this quarter because they had to shut down showrooms during lockdown, and the recovery has been quite slow in a lot of places. But they did have some more optimistic comments as well. They say, for one, the Chinese auto market is holding up quite well. That's already been the case for the past couple of months, but it continues to be strong. And they also are starting to see a recovery in sales, for example, here in Western Europe, but also in the United States as well. So it's certainly in the early days, but they are starting to see people come back to their showrooms and for things to bounce back.
Thank you, Chelsea. We'll see you tomorrow. It's time to take a trip to London, where a slew of earnings have been released, and Juliana Olayinka is standing by at our London studio to take us through these numbers and more. Good afternoon, Juliana. More earnings out there. You talked about Lloyds Bank with Chimmy in the morning, and now we have Shell. How are these not too impressive results driving sentiment at intraday?
Good afternoon, Bissy. Well, the FTSE is nursing triple-digit losses at intraday. I think these lows we've not seen. At the very least, it appears as if unemployment is what's really driving sentiment. Lloyds, when they released their trade report this morning, they hinted at that. And then just a couple of hours ago, we had some breaking news that TUI, which is the UK's largest tour operator, will be closing 166 of their high street stores. This is a massive business story. The tabloids here have been calling it the result of a COVID bloodbath. TUI, the operator, released in a statement saying that what's happened over the past couple of months is the most devastating impact to ever affect the airline industry. It will never be the same again. They announced that they'll be cutting 8,000 jobs around the world. They have about 900 employees working within their stores here in the UK, and they're hoping that they'll be able to transfer them to other branches of their business. But again, a devastating blow to the UK's labour market that, of course, is already seeing thousands upon thousands of job losses. So at intraday, the all-share is down 1.45%. The FTSE 100 is down by 1.63%. And the FTSE 250, the domestic market, is down by 0.94%. Of course, this has helped sterling. The pound is up on the US dollar by 0.02%, up on the euro by 0.42%, and up on the Japanese yen by 0.15%.
Well, still talking about earnings, Juliana, UK-based bank Standard Chartered says that its first half profits had slumped and restated its commitment to Hong Kong despite criticism over its stance. Is the market also getting some form of reaction to Standard Chartered's statement?
No market reaction to Standard Chartered's announcement this morning. Standard Chartered, it's mainly a bank for the developing and emerging markets, so it hasn't really been picked up here in London. But I've got to say, Standard Chartered are really echoing the results we're seeing from Standard Chartered, are echoing the results we saw from Lloyds this morning, Barclays yesterday, and Santander earlier in the week, that credit impairment is really hemorrhaging them. Their shares dropped 3.9% when they released their statement this morning. This time last year, they put aside $254 million for credit impairment, which is bad loans. That's increased to $1.58 billion. So that's a massive increase. They've cited the fall in interest rates. It's also the fall in oil prices. And you mentioned Hong Kong. They're closely affiliated with Hong Kong, and they are supposed to be politically neutral. They came out a couple of months ago basically saying they back the national security laws that China are imposing, which of course didn't do them well. They haven't fared well in that. So they basically said in their trading report that they're closely watching this, and the developments in Hong Kong have lowered their forecast in the region because geopolitically there's tensions there. There are people out on the streets, and also we are seeing a new surge of COVID cases in that region. So not a great day for Standard Chartered, but again, just echoing all of the results we've seen so far from the big banks this week.
Certainly not the best of times. But small businesses that racked up losses and debts will now be eligible for loans of up to £5 million as the government is expanding its COVID-19 rescue loan scheme to, of course, cover small businesses on the edge of collapse. But then Labour is saying that this may just be too late for many troubled firms. Tell us, what exactly is the true situation?
Well, I can report the facts, and the facts are that some businesses couldn't apply for the coronavirus business interruption loan scheme because they were already in bad debt until Britain leave the EU formally, because we are still within the transition period. There's an EU law that prevents people that are in debt from applying for state aid. There seems to be a tweak in the law, and as soon as that tweak was made, the Treasury picked up on it, and now they've said that these businesses can apply for the loan. So if you have a turnover of less than £9 million a year and you have less than 50 employees, you can access this money. I believe it's up to £5 million. You mentioned Labour and them saying it's too late. The CBI, the Confederation of British Industry, have welcomed the move. They said any expansion to helping people access funds at this dire time is really important, so they're glad. But there have been some concerns from observers saying that this is a bad move for the government to make. Already the banks are crying out about how much they're putting away for credit impairment. And also as well, what they are saying is that it's the taxpayers that are going to have to pay back these loans, that businesses that were in a bad state before COVID-19 shouldn't be able to get themselves out of that bad state because of COVID-19. So a lot of observers think that the British government should let these businesses die rather than revive them. But the Treasury have come through, so now they'll be able to access these funds.
At least some relief there. Thank you, Juliana. Do enjoy the rest of your day. And US stock futures fell today following a session that saw major averages posting solid gains after the Fed Reserve pledged to maintain its current stimulative measures. Dow Jones Industrial Average futures implied a loss of more than 250 points at the open, and the S&P 500 and Nasdaq 100 futures also traded in negative territory. But the Fed kept its overnight US rate in a range between 0% and 0.25%. On our domestic commodities market update today, we're turning our attention to gold. Of course, prices edged lower today as investors' appetite for riskier assets improved after the Fed Reserve pledged to support the coronavirus-battered U.S. economy, although a weaker dollar limited losses for the bullion. Looking at the prices, we saw spot gold fall 0.3% to $1,964.51 an ounce, and U.S. gold futures were up 0.3%. Well, joining me now to talk more about the developments in the gold market, particularly in Nigeria, is Mayowa Ige, who's a research analyst at the Financial Derivatives Company. Good afternoon, Mayowa. Thanks for joining us on the program.
Good afternoon, BC. Thank you for having me.
The president recently received Nigerian mined gold from the CBN, and he's approved that Nigerian gold should be produced and used for external reserves accretion. Now, with the price of gold, which is now at about an 11-year high, and the external reserves, which has just fallen below $36 billion now, do you think that this altogether is a good development?
Yes, I actually think it's a good development because gold is considered to be a safe haven asset because it's maintained its value over time, and also it protects against inflation and in cases of political and economic uncertainties. And also governments tend to hold gold in order to protect the credibility of their currency. And over time, we've seen the shortage of the fall in our foreign reserves in Nigeria as a result of shortage in foreign exchange earnings due to decline in oil prices and also increased demand for the dollar. So the government actually is looking for ways to boost our revenue, foreign reserve, and this is actually a good way of doing it because, and looking at it, the government is looking to hold gold as a means of doing that. They're looking to have an annual revenue of $500 million in gold as a form of holding revenue, and I think that this can actually be achievable if we actually pay attention to gold right now. We have mining companies like Thor Exploration Limited suggesting that Nigeria could actually be the next frontier for gold rush because other gold miners are actually meeting a shortage of gold mines across the globe. So Nigeria could actually tap into this and it could be beneficial to our foreign reserves.
Now, there's been a surge in the price of most precious metals, especially gold, like we've talked about. But there's an inverse relationship between the price of gold and the value of the dollar. Of course, they always go hand in hand. But what does this rise in the price of gold mean for the Nigerian economy and our main export, which is oil?
Okay, so the inverse relationship with the gold and the US dollar is basically as a result, because when you see the value of the US dollar dropping, you see the value of other currencies increasing, and then when the value of their currencies increase, they start buying commodities, and gold is a commodity, and that increases the price of gold. And also there's also said to be a direct relationship between gold prices and oil prices, in the sense that when oil prices increase, you see an increase in inflation and increase in gold because gold serves as a hedge against inflation. And then with this, over past few months, we've seen oil prices decline drastically and also pick up a bit, but not to the price that it was before the decline. And the pandemic has also led to a decline in the demand for crude oil. But even in all of this, we've seen gold prices increase, which is not exactly a direct relationship if you look at it. And then all these issues have actually raised important concerns about the future of crude oil, because we're going to see a rise in electric vehicles, and there's a shift to renewable sources of energy, which is showing that oil is not the future of oil. Oil prices will probably hit a demand peak in the near future and begin to decline, and which shows that Nigeria cannot continue to rely on oil as a major export source. So there's a need to diversify the economy. This is where gold comes in. Gold can actually be a good option for that. And then when we diversify our economy, we can get more revenue from gold. When we get more revenue from gold, we can fund our revenue gaps, boost our foreign reserve. And when our foreign reserves are boosted, it can actually help defend the naira against further devaluation, which will be beneficial to our economy. And also with an improvement in our mining sectors, we have more jobs, which would also be beneficial to our economy.
Yes, talking about mining now and, of course, wanting to make more money from gold, so to speak, perhaps that explains why the federal government has declared a total war against illegal mining and cross-border banditry in Zamfara State, which, of course, is to, fight the illegal mining of gold and other metals. Now, how do you assess this initiative of the federal government? What would you think, or how would you assess the impacts they would have?
So I think this is a very good initiative, and the government is actually taking the right steps to actually implementing this initiative in a good way. The government earlier this year set up an initiative, a development. It's called the Presidential Artisanal Gold Mining Development Initiative, where they are registering local artisanal miners, and they're making them like a form of regulation, bringing them into the market, integrating all activities in the mining sector, and also formalizing the environment. And this initiative is backed by the CBN. So these miners mine gold, and then the CBN buys the gold from these miners at an international price. With selling this gold, the CBN buying the gold from them at an international price, there'll be little or no need or incentive for them to actually smuggle gold out of the country, because they're already selling to the CBN at the price that they would have actually sold to people outside the country. So yes, I think that the government is actually taking the right steps to doing this.
And we hope to see results pretty soon. Thank you, Mayowa Ige, research analyst at the FDC, for coming on the program.
Thank you for having me.
Let's head now to Namibia, where the government has approached the International Monetary Fund for a $4.5 billion Namibian dollar emergency loan to help fight the COVID-19 pandemic. According to a Ministry of Finance spokesman, an application was submitted to the IMF last week, and the government is waiting to assess the terms and conditions to see if they are favorable. Namibia had previously avoided loans from the IMF since becoming a member in 1990, but the coronavirus pandemic has seen many nations seek assistance from the lender in recent months. In Namibia, confirmed COVID-19 cases have surged in recent weeks after a slower infection rate at the start of the outbreak in the country in March. South Africa's headline consumer inflation quickened to 2.2% year-on-year in June from a 15-year low of 2.1% in May. Data from Statistics South Africa shows that on a month-on-month basis, the consumer price index was at 0.5% in June from 0.6% the previous month. Core inflation, which excludes the prices of food, non-alcoholic beverages, fuel and energy, was 3% year-on-year in June, compared with a rate of 3.1% in May. On a month-on-month basis, core inflation quickened to 0.3% from minus 0.2% in May. Well, just before we go, Kenya's Central Bank, Patrick Njoroge, says that underlying economic numbers point to strong growth for the country this year. And according to him, the high production of tea, maize and cement hit at a very strong recovery in 2020 despite the COVID-19 pandemic. And that's where we end today's program. Thank you for watching IMBC at Dubai.